A few things. So one is the bigger managers, I said, they want to be able to give you large licks of money. We can't because of the way we run. We're very specialized. Second is that 5-year track record is a formula. So the computer says, no, you can be the best fund in the world. In the Wall Street Journal, the formula says we're not allowed to give you money. Your problem, Patrick, is you built a great product. You talk about risk, you talk about return, but the mechanics of the product don't suit the capital of today, and that's the managed accounts. So what you should do is create a framework that suits what they want and then slap on a product. And that's how you build a business. The reason we were able to grow so quickly, well, quickly if you like, we went from 0 to 20 mil in 12 months. Doesn't sound like much, but there's a lot. Our core investor base, this is through referral, through online, through whatever, of bankers. Because investment bankers live and professional investors live and breathe risk. And when people like that looked at what our product was, they went, this is a no-brainer. This is an absolute no-brainer. You're asset backed, you give me that sort of return, you can get the money.
Running a business can feel lonely, especially when the decisions get heavy. Welcome to CEO Risk Pro by Saurabh Jain. Practical insights from the boardroom and the meditation cushion. I'm Saurabh. I've done 10,000 hours in 3 major parts of my life. I've spent 10,000 hours being a CEO, 10,000 hours being a board member, and 10,000 hours meditating. What we're going to do in each episode is really unpack a real business challenge that a CEO is facing and see if we can work through it together. Enjoy. Thanks, guys. Welcome to another episode of CEO Risk Pro. Today I've got Patrick from Rixon Capital. Do you want to introduce yourself?
Yeah, thanks, Sarah. Patrick William, I'm co-founder and managing director of Rixon Capital. We're a specialist boutique SME private credit fund manager. We've got 2 funds at the moment. The Rixon Income Fund, which is a high-yield asset-backed strategy. That's at about $170 million funds under management. And a brand new fund, the Rixon Credit Opportunities Fund, at about $2 million. It's 1 month old. And that does high-yield cash flow lending.
And just to probably explain to people, so what do you do? So basically, it's a small company. They need to borrow some money. So they'll come from someone like you. You'll collect a whole bunch of cash from a lot of people and lend it out to lots of individual people. Is that the gist of it?
That's a great summary.
Yeah. Okay, perfect. Okay. Yeah. So the idea is I've got some money. I can give it to you. I'll get a better return than I otherwise would. And you'll diversify the risk across, 50 or 100 transactions.
Exactly.
Okay, cool. Yeah. Perfect. Makes sense. So the way we run this podcast is we think about a business problem that's kind of top of mind for you. And we'll kind of workshop that and talk through that. Have you got something that's kind of top of mind for you, something that you're struggling with or thinking about?
Yeah, look, a key priority for what we call an emerging fund is raising money. So we've got a great product, we've got a great reputation, 3-year track record. But when you're not a $1 billion fund or you're not a retail fund, it's hard work raising money. So, we've got a group of investors who look after us and like us, but to go out to the broader market and access larger pools, that can be a challenge.
Yeah. So is that the key problem right now is how do you raise more money? And just for everyone else, because I imagine the way it works is you'll get a percentage of fees under management, maybe some percentage of the upside. So really the more you manage, the more you can push your cost base against a larger revenue base of fees that come in.
Exactly. No, we're not asset accumulators, so we don't do deals and grow the fund because the money is there, but there's enough demand from borrowers in our space that, we'll do 1 or 2 deals every month. We can do 4 to 5 the capital.
If you had more money to lend out.
Absolutely.
Okay, perfect. So is the problem that, how do you raise more money? Is that what you're trying to do?
Yeah.
And do you have a specific goal that you're trying to get to? What is good for you? Is it to fill up this new fund that you have that's currently at 2 mil and get that to a higher number? What is success for you?
So, long-term success is for Rixon Capital become a large multi-asset manager. Multiple funds managing, well over $1 billion.
Yeah.
But if you talk about the 36-month goal, let's take the Rixon Income Fund, which is a bit more established, to about $400 to $500 million. It's a niche strategy, so we expect a plateau there. But it's to take that fund to its full extent. The new fund, which is at $1.5 million, is nascent. That's got a material addressable market. So again, going to market and making sure we can grow that because the demand's there from qualifying borrowers.
Yep. Okay, brilliant. Well, tell us a bit of the backstory. So how did this all get started?
So I started my career in M&A and with Macquarie Capital of Singapore and Sydney, then a boutique M&A house in Sydney called Equasia. And then about 2018, we concluded very correctly. Advisory is a lousy line of work because it's so transactional. When you do a deal, You're paid, you can pay wages. When you don't have deals, you're worried about your job. And we realized funds management was a sustainable business model. Collect a pool of funds, you deploy it, and you get yourself a management fee. Ensures all the bills are paid, everyone's got a job. Perfectly timed for when that realization occurred was the Hay and Royal Commission, where the banks effectively pulled out of SME lending. So we had an opportunity to set up one of the first private credit funds in the country. I transitioned from M&A into private credit then. And so I ran that fund for a year, then moved to another fund where we ran money.
So you ran a fund for somebody else, or was this with
somebody?
Okay, yep. Okay, this was you learning, figuring out how it all happens, what you need to do?
Absolutely. It's a big transition from advisory.
Mm.
So I did that for a year, but I was still doing advisory work on the side, and I wanted to become a pure play fund manager. So I left and moved to another shop where I ran their private credit strategy. We had a bigger team, a lot more money. And that's when it came to me that this can't be that hard. Surely I can do this myself.
Yep.
Yeah.
Okay. And then how long before you then set up Rixon Capital? How long before you got started? What year was that in?
So the idea came about in late 2021. We launched Rixon Capital in mid 2022, and the fund launched in September that year.
Okay. I mean, the realization you came to around, recurring revenue, it's the exact same as the tech industry figured out probably about 2010.
Yes.
That is great selling a software license. And that's what everyone used to do. You should charge $1 million license fee, 20% per year maintenance.
Yeah.
And then you give them free upgrades. They thought, we're better off charging $1 million a year.
Mm.
And that's what they did, right? Because with recurring revenue, you just have this blanket of safety every month, as I'm sure you're experiencing now.
Yes.
As opposed to chasing these big kind of Krispy Kreme M&A transactions.
Yes.
You get a whole bunch of cash, but then you might go very, very quiet for a long period of time.
It makes growth very difficult to plan for,
Mm.
right? Because you might
have these huge ups and downs, right?
Yeah, because you have a good year, you get confident, you go, look, we'll bulk up the team, and the economy slows, and then you're letting people go. Whereas with us, I know exactly what we're getting every month.
Yeah, and the old model as well makes you very reliant on key people.
Very much.
Because M&A, you're probably buying from a person because that's the person that will do your transaction.
Yes.
But funds management, even if your best manager left, funds aren't going anywhere, right?
No.
Like they're kind of tied into Rixon and not tied into an individual. And because if an individual leaves, it's very difficult for them to then go to their old funders and say, hey, put some money into my new one because, well, the money might already be locked away in the old fund.
Yes.
And if it's doing well, it makes the cost of switching very, very hard.
It does. Well, that's an interesting point. So for our business, because it's still relatively new and I'm the principal in the public face, it tends to require me to be involved, which is fine.
On the sales side of things to try to raise capital?
To raise capital. And what we're trying to do very consciously is to transition away from that. Because to your point, it's the business that's good. It's not about me. We've got a framework around how we raise money, deploy money, manage the fund. Irregardless of who runs it, the framework is there. And as long as you comply, you're going to end up with the same result.
Yeah. So how big is Rixon now in terms of employee size? I mean, besides fund under management, what other metric do you guys use?
Yeah. In terms of employees, 5 full-time employees, executives.
Yep.
And we've got 3 people on the investment committee.
Okay. Brilliant. And so how do you raise money today? How does this happen?
We've been very fortunate. So we've got about 8 wealth managers who really like us and support us. So there's regular flows from them every month. We've got easily 400 individual high net worth investors we've accumulated over time. They top up. Most of them top up every month, every quarter. And then we're out here doing things like this, podcasts, business TV, Ausbiz, Google Ads, YouTube, and people find us. And so a lot of word of mouth as well.
Well, I mean, is it kind of working right now, the growth? I mean, it's just not at the speed that you want it to be, is it?
Yeah, exactly. It works, but there's so much more we could do if we had larger licks of capital.
Yeah. And I assume that you publish your returns, do you?
Yes.
Yeah. Like what kind of returns does your fund provide or historically has over the last 1 or 2 years?
Yeah, look, target return is 10 to 12% per annum net, and that's all paid in cash. The last 12 months has been 11.5%, and since inception, about 11.8.
Okay, so it's a good return.
Wow.
It's a good return. So why rush it? Like, why not just let this organically grow? Because if you're kind of giving that return, you'll probably get like 20% more funds under management every year, right? Most people will probably just reinvest their dividends.
Yes.
Because they're like, oh, wow, this is good. I want this to grow.
Yeah.
And if it continues, they'll think, well, I've got this other cash with somebody else. It might not do as well. I'll give that to Patrick at Rixon because I
Yes.
reckon he's doing all right. Well, why not just let this organically grow?
Because there are two sources of uses for our capital. So one is existing borrowers who draw down. So we'll give someone a growth facility of say $20 million. They'll take $1 million on day one and we'll give them money every month over 2 to 3 years. So we've got regular draws there. So if we just sat back with the flows we have, that's pretty much all we do, which is fine.
Yeah.
But the extra money allows us to write more new loans. So you keep building the fund. But as the fund grows, the draw from those individual draws increases as well. So you are chasing your tail. As it becomes bigger, you actually require more funds.
Cool. Because I imagine that if you can't do these follow-on transactions, they'll go to somebody else, I imagine.
That's right.
So just to recap the last point. So if you don't have more funds to follow on for these small SME businesses, then they might go to somebody else, they'll establish a relationship with them, and then you might not get more work.
That's right. Well,
Yeah.
generally they'll go to their shareholders or some family office.
And find money elsewhere.
They'll find money elsewhere. And not even on better terms either, but they need that money to grow. So we offer the best terms of the market, but if the money's not there, you can't wait.
Yeah, sure. Okay. And what rate are you growing at now? Like, well, what is a good growth rate for you today?
Look, we grew by 70% last year. So, growth rate we're targeting growth rate of at least 50% this year.
Yeah. Then isn't what you're doing already working? Like, why do something different? If you already have these 8 wealth managers, isn't the goal just to go find more and make sure you're freed up to go find more people? Like, well, why is this a complex problem?
Because those relationships take time. So and all wealth managers have their own criteria. So for instance, many of them will say, you haven't got a 5-year track record, we won't invest in you.
Yeah.
Or they'll say, I need weekly liquidity, which we kind of aware of. We're writing loans for 1 to 3 years. It'd be dishonest to try and offer liquidity that's less than quarterly.
Yeah.
So everyone's got their own criteria. So because we're emerging, 3 years at 170 mil, sounds like a lot to me anyway, but not to the market. That limits the addressable wealth manager market. So the people who support us are self-licensed specialist boutique houses.
So in terms of the people that you have today on your books that provide you capital,
yeah,
how many more are there out there in Sydney or Australia? Out of the 8 that you already have, are there many more people?
Oh, many, many more. Many, many more. But it's about getting in front of them, number one. Number two, building a relationship. Number three, getting through their due diligence process before that initial lick of capital comes in. So we've got irons in lots of fires, but it'll take months before they convert.
But is it, what I'm trying to understand, is it just a time thing? Because you must be doing this all right. You've got 400 high net worth individuals, you've got 8 instos or kind of, so what do you call wealth managers?
Yes.
Is it just a time thing? You need to wait for, the other 100 to go through a process and at some point they'll come on?
Exactly.
Yeah.
But the challenge is how long is a piece of string, right? Is time a month or is it a year? A month means we can do all these, because remember, the deals don't wait for you. So they're there at the moment. So ideally, we can capture those borrowers today, lock them in for 2 to 3 years. That accelerates fund growth, but also helps investors because their returns stay solid. And B, you're constantly improving the diversification of the fund.
Sure. Yeah. Okay. Well, I understand what you're saying. I just wonder whether it's an actual solvable problem.
It is, but I go back to that. Time is key because the deals are there. So for instance, you don't want to have 6 quiet months or 3 quiet months. You want to be steady on that growth. But again, as you get bigger, the draws of that capital become larger. So you've got to match that perfectly.
But I guess as you get bigger, you'll probably be able to raise funds easier as well.
Yeah.
From your existings and from the returns that you're providing out to those people. So that will kind of solve itself, I'm guessing, to some degree. But you do need to obviously raise more money to give more debt out to new companies because that won't organically grow.
No, that's right.
Yeah. But I guess what I'm trying to understand is where's the complexity in this problem? Because you've already got a whole bunch of 100 irons in the fire across all these other wealth managers.
Yes.
Why don't it just be a process that you've obviously been very effective at and you'll see to fruition? Or is there a complexity that I'm kind of missing? Or is it just an impatience?
No, it's just the certainty of timing. So you can have 100 irons, 1,000. I mean, to use an example of, say, a software business cycle, right? I'm selling a piece of software. I know that the big players, I'm making this up, I know the big players have 2 purchasing cycles during the year. So I can start my process, start the pitching, start the marketing, start the lunches and the coffees, knowing that by June, they will sign. and I will know what my certainty is.
I'm just trying to understand the complexity of the problem, and I guess the analogy of the tech world kind of makes sense. You got might have a buying cycle. These guys might have a cycle for them to select.
Yeah, so you've already got a product. It's sitting on the drive. It's sitting in the server. I know that there are 2 sales cycles, June and December. I work towards them, and then in June I go, look, I've done very well. I've hit 50% of my target, 100% of my target. Well done. Bonuses all around. Whereas with what we do, I need the money in Jan. I need the money in Feb. I need 2 million here, 10 million there. But then I've got a sales cycle that is indeterminate, right? It could be March, it could be June, it could be December. But the borrowers are there. And if I don't put the money out the door, A, I don't get those returns from my investors. But B, you then build a wrong sort of reputation in the market. The Rixon guys love to talk. They've got a great solution, just don't have money. And people will stop picking up the phone.
Yeah. Okay. Are there many other small private credit funds in the country? Are many people doing this like you guys?
Lots of people in the market, but we don't have a direct competitor in this space. So our competition is effectively the family offices. Now, people don't want to go to the family offices because the family offices will try and take equity as well. We're non-dilutionary. But again, right, if the money's not there, you'll take the option that works.
Is there something to the fact that there aren't many other competitors in your space? Is there something not attractive about this space?
It's a small market, simple as that. So we think the addressable market for the income fund's about $500 million tops. You know, if you go and speak to someone at Challenger and tell them I've got this great fund that caps out at $500 million, they'll tell you that's called a failed strategy.
Okay.
Because, you know, if you're $1 billion fund,
it's not worth it at that scale.
Not worth it. And same with the family offices, whereas we're employee owned, you know, 5 guys and 2 business partners out of Adelaide. Makes perfect sense for us.
Yeah, so your cost base is low, your number of employees is low, you'll still do well out of it.
That's right.
Okay. And what are your other sources of funds besides the wealth managers and high net worth individuals or family offices? Where else would you go to?
Well, those are the 2 key sources. Those are definitely the 2 key sources. You know, people talk about institutional money. The challenge with institutional money is they're very large checks, but A, those can be multi-year processes, and B, they don't pay full freight. So, you know, our management fee is 1.5% per annum on funds under management. If, you know, Aussie Super came and said...
They would not pay that. They'd pay you point something, yeah.
They'd say, I'll pay you 0.1. And you go, what's the point? I'm going to do all this work and I can't pay salaries on that.
Yeah. Okay. I'm trying to get it right in my mind. Is this actually solvable? Is this just something that time will sort out for you?
Time will solve it. But the question then is, you know, you're sitting and twiddling your thumbs waiting for money. Yeah. And the danger there is if you're not pushing hard enough and bringing in enough, people stop calling you. And then you're no longer viable as an option. So
what would you do if this was not a solvable problem, if it was only time? That you'll only grow by, you know, X million dollars per year because that's just the rate at which you can, you know, bring on new wealth managers and get more money out of your existing people. What would you do? What would plan B be?
Well, plan B, it's actually someone from the Desi Collective who gave me this idea. He says, look, the challenge, quote unquote challenge you've got is your wholesale fund. So, you know, you're not accessible to retail investors. And B, the redemptions are quarterly and people really like these quick redemptions. So the suggestion is, and this would be plan B, is we set up a brand new fund structure where retail investors can invest. You get a fixed return, 6, 7, 8%, whatever it is, but it's a fixed return. There's a first loss piece that a handful of wealthy investors will fund. They will get a big fat return, 15, 16%. And that business can grow very quickly. But in my mind, look, we've already set up the fund. It works. And it's about rejigging an entire fund structure. We'd like to run with what we've run with for a while before we make that decision.
Yeah. Okay. Well, let me understand more in terms of raising money today. Maybe walk me through the process. Like, how do you go to a wealth manager, a high net worth individual, or a family? Just walk me through that process from kind of start to finish.
Yeah. With the high net worth individuals, they find us. Oh, it's word of mouth.
How do they tend to find you?
I've got a regular slot on Ausbiz, which is a business TV channel, and we speak at events. So, and we're on Google Ads as well. So you look at us, looks up, will pop up. So they fill in an expression of interest form on our webpage. I get their email and mobile, and I give them a call, and then we set up a meeting.
And what's the general pitch to them?
It's a standard pitch, and it's worked very well for us because what we say is, look, what differentiates us from other private credit strategies is to get a higher return in credit, you take on a risk premium. The bigger the risk, the higher the return. But by focusing on an underbanked niche, we're getting a higher return through a scarcity premium. We get a higher rate, not because the risk is higher. It's because the borrower has an option. I can go at 6% and give up 10% of my business, or pay 14 and keep my business. So we're getting a premium return for relatively low risk. Investors love that story.
Mm. And how much does that grow your high net worth individuals? Because if you kind of say, look, the wealth managers, that might just be a long sales cycle.
Yes, it is.
That might take them 6 months, 12 months. It might take 3 years. So you've got a 5-year track record. Or they might say, look, your fund has to be $500 million
Yes.
before we're willing to put any money in it, because below that, there might be too much concentration risk in the debt that you have.
Mm-hmm.
So let's just assume that,
Yeah.
I don't know if there's a lot you can do there.
No.
Then nothing obviously comes to mind.
Yeah.
Because you've just got these structural rigidities that you're kind of locked against.
That's a good way of putting it. It's actually the structure. You need that track record. It doesn't matter how good you are. If you're not 5 years, some managers won't touch you. The other is, because a wealth manager's job is to manage your money and manage it well, not to worry about me. So we've had large wealth managers who like us say, look, can you take $13 million a month? Eyes closed. So we can't, because if we did, and a borrower wasn't there, returns would fall. They go, well, it doesn't suit us there. So by the downside of being boutique is it does limit your addressable universe.
Yeah, totally. And I guess it probably limits you on both sides, like limits you from the very large transactions because you might not have enough customers to push the debt out to.
Yep.
So you'll have cash there that's not earning you any return.
Yeah.
But it also probably goes the other way as well, because you are still new. You've only been around for a couple of years.
Mm.
And often I find with a lot of fund managers, the risk of downside is not worth the upside. You might not be a known quantity to them. They want to see you run for a couple more years.
Yeah.
Like, who's this guy called Patrick? Rixon Capital's only been around for 2 years. They can't give me a 5 or 10 year kind of track record.
Yes.
So like we said, that might not be solvable in a short time scale.
Yes.
And it might just be that they just need to get credibility in you as a person, lunches, coffees, quarterly results, quarter after quarter after quarter. I mean, the analogy I'll kind of give is, so the last company I exited, public company, Urban Eyes, $100 million business. It just took 16 quarters of good ASX results.
Yeah.
It just took quarter after quarter after quarter.
Yeah.
And at some point, the market figured it out.
Yes.
And then everyone kind of jumped on the bandwagon and the share price went up 5x.
Yeah.
So it might just be a slow, boring grind.
I'd agree with that. I think that's what will happen.
Yeah.
It just clicks and people it's brand value. You made a good point there because, I think it's KKR that's had their credit fund gate 2 to 3 times, which is not a good thing, but they can still raise oodles of money because if things go wrong, people can go, look, it was KKR. What else could I have done? And that brand value carries a lot.
Yeah. Well, it was no different to like in the 70s or 80s. Like no one ever got fired for buying IBM.
Yes.
Like it was always a good decision.
Yeah.
And buying from Rixon, even if you give me 2% more return, if I'm a wealth manager and I've got to go answer the people that I'm getting money from,
yes,
it just might not be worth the risk.
That's right. That's right.
And I'm guessing that's why your sales cycle is so long right now.
It is, because it is building that credibility. And look, with the people who support us at the moment, those 8 managers, we've known them for a while. We've worked together for, most of them on average 2 years. And they've seen those.
What made them sign up? Because it sounds crazy to me. Like someone gives me a call, I've got a new fund. I'm like, I don't know you.
Yeah.
Unless you knew them from your prior relationships.
Warm introductions.
Yeah.
From people with mutual respect on both sides.
And that was enough?
Well, that's a big gate opener, because if someone and really respect goes, look, Saurabh's a great guy, you should speak to. You've passed a lot of gates because when you speak, I'm not questioning your credibility. I'm talking about product and facts rather than feelings. And the appeal we've got for some wealth managers is the fact is boutique funds generally outperform mainstream funds. So there are a lot of investors out there who actually prefer a boutique fund manager, and they will actually divest once the fund hits a certain size because they go, look, there's no alpha anymore. You're just a big fat machine. You run and you're boring.
Yeah. Okay. And so out of the ones that you're chasing now, like how many more wealth managers would you be chasing? You'd be somewhere in like a sales cycle?
Well, look, it's not just send them an email, have a chat. You need those warm introductions, or you need them to reach out to you. That's actually the best way. And then you begin that sales cycle. So.
And how many would you have? Would it be like 100? Would it be like 1,000? Like how many people would be going through that process with you guys in all various stages?
Oh, look, about 15.
Okay, so you got
15, 1-5.
1-5. So you got 15. Is it a case then maybe the only way to solve the wealth managers is to get more warm intros?
Absolutely. Whenever people say, oh, what can I do for you? I go, if you know a wealth manager or a high net worth or family office, introduce us.
Yeah. Okay. Well, that might just be one that takes time, I guess.
It is.
Yeah. And probably I assume you're already doing this, right? You're already probably trying to reach out to lots of people, have lots of coffees, network really well. So more people know you. So if someone knows someone that knows someone that knows a wealth manager,
Yes.
that will think of you.
Exactly. And we've got a really good profile on LinkedIn. So, we provide topical content. So not spruiking the fund, actual topical content on industry interviews and such. So, we've got lots out there. And the value in that is to show the market there's this fund out there that has good views, runs very well, is very open, number one. And number two, by virtue of the brand being there all the time, builds familiarity. So people go, look, I don't know them, but I hear about them all the time. 50 likes and all these positive comments. It just builds that trust.
Yeah. And I think the other thing it is I think you just want to be top of mind when they're thinking about this. When they're thinking about, I've got to allocate some capital, you just want to be one of the companies they think about.
Absolutely.
So I think about 90% of the time, whatever companies they think about, the top 2 or 3, that's who they end up buying from.
Yes.
Yeah. Okay. That kind of makes sense. So we should have even asked at the start. So if let's just round it up, say you're $200 million, you're getting 1.5%. So you're charging, say, $3 million worth of fees, which are fair and reasonable across 6 people, bit of cost, you're kind of doing okay. When you get to $500,000, that's when everyone does really well, right? That's when you've got enough debt out there, you've really diversified your risk, you're making a meaningful fee out of it.
Yes.
How long will that take you, do you reckon, if you just do what you're doing today?
Probably 24 months, 24 to 36 months. Yeah.
Okay. So you'll double the fund in more, right? 2.5x.
In 2.5 years.
Yeah.
And it's very much the point that you made, because as the fund grows larger, it does get easier to raise money, but it comes in big licks. So, you sit there and you go, oh, far out, I'm done so well. No one wants to deal with me. And then one day it's $20 million. Step up. Then it's quiet for a while, another step up. So we expect that to accelerate over the next 24 months.
And do you outsource the task of raising this money? Is that a thing in your industry?
Very much. Well, there are 2 ways to look at it.
Like equivalent like a broker or something. I know when we raise money either public or private.
Yes.
Often we bond to a broker, you pay them, 4, 5, 6%, whatever their fee is, and they go raise the money for you.
They are, but they're very expensive and they're not viable. So what we are looking to do at the moment, so we've actually got a recruiter, is hiring a distribution person. So that's effectively your in-house broker, someone who specializes in raising money for funds, and has a suite of relationships. So the good guys are hard to find. We've got a handful of good candidates. So that could be a game changer for us.
And how do you find someone like that?
The recruiter always helps, but it's a small industry, so you know some of the names. So it's just about whether or not someone is A, happy where they are, B, looking for something new, or C, working somewhere where that asset class has lost its shine, because their bonus is on how much money they raise. So if you're selling an asset class that isn't popular anymore, you'll be looking for a new job.
You're going to raise less money, and that kind of makes sense. Okay, so that will kind of increase the network, increase more referrals, and all those kind of things.
So the right person will be a game changer for us.
Yeah. Because I imagine right now you're that person, are you?
Yes.
And are you then also the person that brings the work in as well?
No, it used to be, thank God, no longer the case. So, for the way you describe a funds management business is it's an airplane with 2 engines. You've got one engine that's the borrowers, the other engine is the raising money. The borrower side is well covered. We've got a team of 4 exceptional people running that. That's a machine, just runs like a well-oiled machine.
Give me a bit of a profile. What's a typical company that would borrow from you? Like what's an example?
The best example is what I call other lenders, so non-bank financial institutions. So John has set up a business. It is an equipment financier. He's got a great market. He's looking to target. He makes good returns. He's got a very low loss rate. And all this is done with, call it $1 million he's raised from friends and family. Now, he's got this lending business, makes a good margin. He needs to grow it because it's $1 billion addressable market. The problem he's got is the banks say, when you want a $100 million facility, call me. The big funds say, call me at 15. John says, I'm at 1. What do I do? And that's our target market. So we turn up and we'll tell John, we'll give you a $20 million facility. We'll give you $1 million on day one. And as long as you've got growth, we'll drop money into you. And then we'll help them grow that book until they can refinance out with someone else.
Okay, so it's a small business needing what, $1 to $20 odd million in various chunks.
Yes.
What's a typical loan size that you'll do, or is it always these drawdown facilities? Is that what you guys prefer?
They're primarily drawdown facilities.
Yeah.
So day one checks are anything from 1 to 10. 1 to 5 is a sweet spot. We like that. But most facilities have an upper limit of $20 million.
And where do you get most of your borrowing work from? People reaching out to you directly, is it?
Reaching out directly, yeah. And referrals from directors. So I'm a director of a business. I've used Rixon. Someone else's that I sit, whose board I sit on, says, look, I need this money. No one wants to give it to me, or they're all trying to rob us. And he says, I know who you should call.
Okay, then they recommend you, and then the work will come through. Okay. Well, let's go back to the raising the money side. So that's the crux of the problem. Then
Yes.
There is no easy solution, really.
No, there's not.
You can try the distribution thing. That might work. You might get a great person. They might kind of help. You might get more network connections as you grow. It'll kind of solve itself a bit, but maybe not at the pace that you need. Besides that, in high net worth individuals, and let's assume you can't do retail. That's just too hard for now. Any other options for yourselves?
Well, the one option that's always hanging on the back of our minds is there are family offices that like what we do. And the promise they've got, or the pitch they've got, is let me buy into your business and I will open the taps. And I've got 20, 50, $70 million that I manage for my family and other families they'll give you, which means you step up straight away.
And what will they take from you in return?
An equity stake of some form. And everyone wants way too much. For a business that's profitable, it's way too much.
Because I mean, all that kind of does is speed up your growth a bit, but then it might cost you, that growth might cost you too much, right? If you have to give up meaningful equity and you're kind of growing anyway.
And that's exactly the point. It's sort of the point you're making, right? With time, we'll get there. So is it worth giving away 5, 10, 20%? Number one. Number two, it adds complexity. So, we've already got a business owned by owned by employees. We've got a financial partner of Adelaide. They've been very good partners. We get along. We know each other. When you bring in a new party who might have their own agenda, just risks creating conflict.
And it sounds like, yeah, look, I'm sure that's what you're thinking. Like, it just sounds like it's not worth the grief.
No.
It might bring your growth 3 months earlier or 6 months earlier, but then you might just totally get in bed with the wrong person.
And and it's not necessarily them doing the wrong thing, right? It'll be a debate about salaries, bonuses, or
There'll be some misalignment somewhere, right?
I want to exit in 3 years. Why aren't you supporting the exit? I said, look, that's not what we want. So whereas the core group we have a aligned vision.
Yeah. And it's more fun being the boss in control.
Oh yeah.
So you can do what you want, right? Between you and your co-founder and the 5 people, you can decide to do whatever you want.
Yes.
You don't have to answer. So that, I think you're right. That doesn't kind of make sense.
Yeah.
Especially if that kind of money will only bring you, how much forward did that bring your growth? What, 3, 6 months or more?
Yeah, look, let's be generous, say a year.
Yeah.
A year. Look, it is helpful. It's always helpful, those step changes. But what you don't want is in 3 years' time to look back and go, I should have just waited. And here we are having these angry phone calls and meetings.
Yeah. Okay. So high net worth individuals, kind of their family offices, too hard. They're going to want too much skin for their funds. And any other options you guys have?
That's pretty much it. That's a lot of money. If you look at self-advised high net worths, the wealth managers, that's a multi-billion-dollar market. It's all about getting in front of them, educating them, and selling the product.
And how do you get in front of the high net worth individuals? That's referral similar to wealth managers, is it?
Referrals are the best. So again, I speak on AusBiz on private credit every 2 weeks, and they've got a fantastic viewership of self-advised high net worths, and we get a lot of leads there.
And what rate is that growing at? If it's 400 now, how much would you expect that to be in 12 months' time?
400.
If it's 400 high net worth individuals today,
oh yeah,
how much would you expect that to be in 12 months' time?
Probably 600.
Okay.
Because as the fund grows, the check sizes grow as well. Because as an example, when we first started, we had investors who gave us $50,000. And the reason they do that, they're very frank. They said, look, I don't know you. I don't know you. I can afford it if you run away with my $50,000. But as you grow, people go, look, I like what you're doing. Here's $500,000. So it's real step changes.
Why is there a rush to grow? Help me understand that. Like, what is it inside you that's making you want to grow so quickly? Don't get me wrong. I've come from a tech space, right? Where it's always about grow as hard as you can.
Yes.
But in a tech space, you don't have the same constraints.
No.
And I'm trying to understand, and in your world, the constraints have a real cost to them, right?
Yes.
So in your world, why try to grow so quickly?
So be very careful how I answer that because it's not unconstrained growth. It's growth because the opportunity is there.
Mm.
So, I'm an entrepreneur where I run my own business. I can see this sea of opportunity and I go, why am I tapping 10% when I can tap 50 or 60%? But if I can tap 50 or 60, I can build the team and launch fund number 3 in 2 years versus 5 years. So it's a matter of practicality almost, right? It's there. Take it.
I hear you, but let me say that another way. I mean, conversely, let's just say you've got 100 potential borrowers out there.
Yeah.
Today, you can service 50 because that's how much money you have.
Yeah.
Um, if you service the best 50, you'll do better than servicing 100, right? Because there will be a top 50 or bottom 50. So if you're very, very selective about who you lend money to, you'll probably have a higher return. You'll have less bad debts. If you're giving like 11.5% and you're charging them, say 14%, take out your management fee, like you're not getting a lot of bad debts.
No, it's a very good book. See, that's
Yeah.
also a very good point. So what appeals to investors when they look at us is we're an asset-backed lender. So if you tell them, say, I want 80 cents, I'm taking $1 of plant, property, equipment, receivables off you. So
it's secured against something.
It's secured. So when I say there's an addressable pool of 100, I'm talking about 100 who tick all those boxes. I'm picking 50. So I'm not taking the top 50. I'm taking the first 50 because they've taken the money. I'm tapped out and I have to let the others go.
Yeah. I mean, what about just, good old supply and demand? In your case, demand's outstripping supply. So what do you do? You just increase the price. You charge them an extra percent, extra 2%. You charge them a sign up fee, whatever you can to extract more from them. You screw them for options. You screw them for warrants, all those kind of things.
Yeah.
But that's what I've been on. I was on a public company, Space Talk. We got totally screwed by warrants, by Pure.
We know them well.
Yeah. So why don't you do that? It's not about increasing the fund size. It's about, well, okay, maybe the fund size will grow at the speed it'll grow. We'll do all the right things. We'll get distribution, person on site. We'll get more marketing. We'll do more, coffees, more lunches. We'll do more networking. That will grow.
Yeah.
But if we have more demand than supply, maybe we should see how to make more money off these guys.
See, theoretically, that makes sense. But if you break it down, so one example is, there are a few things, in fact. So one, what makes us different is, and appealing to borrowers is, we're high yield, we don't take those warrants. Because as soon as you say, I'll take warrants, they go, look, there are 4 other guys who do it. And then you're competing on price and terms. So if we do that, we're no longer different. In fact,
so you've lost your differentiation. Okay.
Completely. And then on pricing, now that's a good point because when a borrower comes to us, a lending business, these lending businesses make 30, 40% margins. We could charge them 20. But the danger is, number one, we charge someone 20, it ticks off the borrower. Because remember, the fair price is 7%. So the borrower views you as usurious. And they tell people in the market, look, the Rixon guys gave us a solution, but far out, bunch of sharks. But I charge them 14 to 15. They go, look, they're expensive, but they're good guys and it's fair. So there's a psychological element to it. And it's also the fact that I don't want to put pressure on my borrowers. Because, there's a point where a borrower wobbles, not because the business is struggling, it's because you're taking too much. So that sweet spot of 14 to 15 makes sense for us.
Sure. Because I guess if you do charge a lot more, then they might not be able to pay and put more pressure on their business.
Yeah.
And the entire debt might be worth less.
That's right.
Okay. What else can you do then?
Look, we just market like mad to get our profile out there to investors. So that's all I spend all day doing. LinkedIn, emails, phone calls, coffees and lunches, nonstop. And it pays off, right? It's very tiring, but what happens is the first time you're a stranger, the second time I've seen this guy before, third or fourth time it's like, hey, Patrick, nice to see you. And at some point it becomes a check. So it's just this constant grind. What we're trying to get to is where we don't have to do that grind anymore. Because in reality, right, when you think of a fund, that's not what a fund should do. Fund's job is to invest equity, debt, hybrid, and deliver a return that investors want. And the money should come. It's the early days where you've got to tell people, hey, think about me as well.
Yeah.
And that's a hard slog.
Yeah. I mean, what percentage of your cost base, like, if you have to allocate your salary and the other 5 people, what percentage of your cost base do you spend on sales and marketing and raising money?
We don't spend money on raising,
But in terms of time and hours and those kind of things, or mind space?
Look, for me, it's pretty much a full-time job. So, 20% of our wage cost is on marketing, and we spend a lot of money on advertising. So Google Ads, events. We hosted the polo with one of our big wealth managers last year. All those things cost a fortune, but A, it's a great way to show your partners you care and you treasure the relationship. And B, it shows investors that, it's not just I take your money and your fees and go away. It's the pitch of a boutique fund. We catch up, we do lunches together. You can call me in the evening if you're worried. And all that builds that trust.
Okay. So really it's more than just raising money. It's almost like a growth strategy for you, right?
Yes.
Well, assuming that you've got more demand than you can possibly supply on the borrowing side, it's how do I grow, raise more money? And you've got, you've got your marketing, you've got direct sales, you've got a distribution person that might come on board with a bit of network, a bit of connections. What else are you doing in that space?
Look, those are the key ones, that marketing. I mean, this is really left field, is building out that second fund. Because what we've been told is some wealth managers want to see a menu. So if you turn up, I've got one product, you'll go, look, not for me, and the meeting's over. You turn up with 4 products, it opens the doors, because I might like the equity strategy. I might like the higher risk strategy. I might like the low risk strategy. And that's a door
So
opener.
you have a multi-fund so they can choose which one kind of works for them. Okay.
So, but perversely, that's your point about time as well, right? As we grow larger and bolt on 2, 3 funds, it becomes easier, when I'd rather it be easier today.
Yeah. Yeah. And do many other companies offer what you offer to these fund managers?
To the wealth managers.
Yeah, so to the wealth managers.
For our niche, if you look at it from what we do, where we invest.
So the niche being, low risk, high return, 11, 12%, 10 or 10, 12% return, small business lending.
Well, take a step back on first principles, very high return for relatively low risk monthly cash payments. That's the appeal.
Okay.
So you give us $100, you're going to get a yield, you're going to make $10 to $12 a year, and that $100 is capital protected, because it's asset backed. Now, it's not a guarantee, but there is an underlying asset base.
Yeah. So how come you're not growing faster then? Because that sounds pretty good. You've already got 2 years of track record. Let's just ignore the fact that you don't have 5 yet.
Yeah.
How come you're not getting more and more from your existing wealth managers? How come they're not just, totally throwing more cash your way because, oh my God, this is amazing. This is like the perfect crime. It's low risk, asset backed, reasonable fees, high return.
A few things. So one is the bigger managers. I said they want to be able to give you large licks of money. We can't because of the way we run. We're very specialized. Second is that 5-year track record is a formula. So it's a computer says no. You can be the best fund in the world. In the Wall Street Journal, the formula says we're not allowed to give you money. Those are the key ones.
Yep.
And then finally, the wealth manager is looking to build a diversified portfolio. So we're delivering 11, a fantastic risk. But then they look at a listed fund and go, look, I can get in and out of that any day, during the day. They're doing 8, they haven't blown up. Broadly, the portfolio doesn't move the needle. I may as well stick with them.
Yeah. Okay. I've had a bit of experience in this place. So the public company just came off the board of TrialKey, just rebranded to Pathkey. We partnered with another company to set up a fund, specifically a fund that invested in bio. We had an AI algorithm that would predict the outcome of clinical trials, get it right about 80% of the time. Small bio trial failing, they go to 0. Trial succeeding, they tend to go up. But the only way that even though the fund was amazing, we were returning like 30%. Yeah. But the only way we got any meaningful capital was we had one cornerstone investor, a guy called Tony G, worth hundreds of millions of dollars. He was happy to back it. Yeah. He was the major shareholder in the tech side as well. And that's kind of how we got scale instantly. Is that an option for you? Ignoring family offices that will steal your kids from you. Is that an option for you to get one cornerstone investor? You do some sort of reasonable deal, which is still fair for you, and they get a slightly higher return?
Yeah. So we had a conversation about that with someone today. The question is how much?
How much upside they're going to steal?
How much upside they're going to take? And we're very cautious because one of those things, if you start the conversation, you're already started on the back foot, right? The negotiation, you want the deal, so they'll squeeze you. So it's an option. There are a few people interested, but unless they approach us, we've got to take the position we are okay the way we are.
Yeah. Well, what are the other lenses of this problem? Like, how are other people solving this? Because every fund needs to raise money, I imagine. Lots of people start funds. How are other people solving this?
First thing I tell you, since I've become a fund manager, an emerging fund manager, there's a group of us who hang around. We meet each other at events. It's very, very, very hard. In fact, we're very fortunate to be where we are, as in everyone's on a market wage and the bills are paid. You'd be amazed how many funds on the cusp will be shut down because it's become harder and harder to raise money.
Yeah. What does that tell you? If lots of funds are finding it very hard to raise money?
It's not because of product. The products are excellent. I know these people. Products are excellent. The people are fantastic. It's what's the phrase? It's not commoditizing. I guess maybe it is a commoditization of product by the industry. So if you went back in time 20 years ago, wealth manager sits there and he goes, where do I put money? Oh, Patrick, I'll have a chat with Patrick. I'll have a chat with Saurabh. Today, a lot of the wealth managers, the other change is they use what I call managed accounts. So your wealth manager doesn't say, I've got you in fund XYZ. They just say, I've put you, sorry, you're reasonably young. I've got you on the 60% growth option, 40% conservative. That's all they know because there's an asset consultant in the back who puts together that portfolio. So the wealth managers don't speak to you. You speak to them and say, look, talk to these guys. And these guys are looking for something that is commoditizable. So the first question is, do you have daily liquidity? Because I need to change my portfolio daily. You go, no, out. Will you pay me a big rebate of your fees? I said, well, my fees are pretty skinny. No, you're out. And that's keeping a lot of people out of the market now.
I mean, are there funds to be raised?
The money? Oh, definitely. Definitely.
Are there funds to be raised that will fit the profile of money that you can take that would make sense at a price that makes sense and that would invest in a fund like yours?
Well, which is why we're at 170 mil, it's that demographic. So I just say to people, the reason we were able to grow so quickly, well, quickly if you like, but we went from 0 to 20 mil in 12 months. Doesn't sound like much, but it's a lot. Our core investor base, this is through referral, through online, through whatever, were bankers. Because investment bankers professional investors live and breathe risk. And when people like that looked at what our product was, they went, this is a no-brainer. This is an absolute no-brainer. You're asset backed and you give me that sort of return, you can get the money.
Okay. I don't know.
Yeah.
I don't know. I mean, I think it's just one of those things that the market will only grow at a certain speed sometimes. And you can churn a lot of money on marketing, and that might improve it. If the market is actually bigger and they don't know about you, they don't have enough exposure to you, or you're not top of mind, that will help grow it. But sometimes there are limiting factors to growth.
Look, I will say the market has changed, and if I had to go back in time with the knowledge I have today, what you've got to do now, and this is good advice I got from, again, someone from the VC Collective, is he says, your problem, Patrick, is you built a great product. You talk about risk, you talk about return, but the mechanics of the product don't suit the capital of today, and that's the managed accounts, those asset consultants. So what you should do, you could do it now, or you definitely do it when you start, is back solve, create a framework that suits what they want, and then slap on a product. And that's how you build a business.
Yeah. So for example, build a product which gives them the daily liquidity and all those kind of things.
Daily liquidity, retail, first loss provision. So look, in my opinion, it's not compelling at all. You look, we talked, he whiteboarded. I wouldn't put money into that. He says, but it's not you're targeting. You're targeting an asset consultant who just tells the wealth manager this is the income option.
Yeah. And how come we haven't done that, or is that still on the cards?
Well, we learned
solve a model that
we learned about that about 2 months ago. And the fund's $170 million. It's a bit late to turn the ship. It's an option. It's something we're talking about, but ideally we don't have to go down that path, because what we're still trying to push to investors is we've got a cracking product. You understand risk. It should be a no-brainer for you to give us capital.
Yeah. I mean, it's hard what you've got that standard dilemma of, do I sell a quality product or do I sell something that's easy to sell?
Yes.
That might not have the same quality.
That's right. That's exactly right.
And you're picking the quality path?
Yeah.
Which might be right, might be wrong. I've got no idea.
And the challenge for us is we've come so far. So, if we were $20 million today and I had that advice, I'd go, you know what, call the lawyers, let's restructure this. But, we've got scale, we've got 2 funds, we've got a great reputation, we're building. Why reset all of that? Because if you reset it, it's a completely different market.
Yeah, and I think the subtlety of it is you've experienced success doing this.
Yes.
You're thinking, well, I've done this. I've got this much funds under management under this short period of time. This is kind of working.
Yeah.
I mean, if it went horrible in 6 months' time, you closed up,
Yeah.
you'd be like, oh, that was a bad idea. And then you'd go set up this retail fund. That would be a lower quality fund, but that would be a lot easier to sell.
Yes. Yeah.
Yeah. So then it kind of makes sense. Well, you've got two options, right? You can stick with the quality, or do you want to play both? But you've got to make sure that a low quality fund fits with you.
Yes.
And fits with your culture, and fits with your personality, and fits with the vibe of your organization.
And your ethics. And that was my challenge. I said, doesn't feel right. And his advice was, it's not about whether it's right or not. That's what the formula requires. So you suit the formula, you're going to have a great product. A great product in terms of structure rather than actual financial product.
That will be easy to sell. People will buy it. You'll have a lower return. You'll have higher risk.
Yeah.
But it will fit whatever box or spreadsheet that someone needs to do.
The automated asset allocators use. Yeah.
Okay. So I get why you wouldn't do that. If that doesn't feel right for you, it doesn't feel right for you.
No, that's right. And we're not a machine style fund. If you look at these big funds, it's a machine, right? Just people coming in and out, and it just churns. We're not like that. That's part of the appeal as well. We're all faces, we're all individuals. You see us at events and lunches, and the investors who have backed us love that. And they find a lot of value in that.
And plus, I think in the long arc of time, I think quality wins.
I would like to think so.
I think so. Like if you look at most areas in our life, like if you look at electronics, like there were all those cheap phones, but then the most expensive Apple and Samsung phones were. Or there was all those cheap laptops. Now Apple and Microsoft own all the ones.
Yeah.
Vacuum cleaners, everyone that I know at least in our demographic buys Dyson. They're the most expensive, but they're the best quality.
Yes.
So in the long arc of time, quality wins, but it takes a long arc of time.
Yeah.
Because you need that time to evidence that this actually is a quality product.
Yeah. Well, that's right. And look, we're good with time, but be nice if it was faster. I mean, my comment around time to invest is always, look, I don't rush anything. So if there are no deals out there, we will not take money. And my pitch to investors is, it's a marathon, right? It's not a sprint. I'm 43, and my youngest is 9. I've got years to go. I can do 1 year with no growth. But if the growth is there, I want to grab it.
Yeah. Okay. What other options are there, right? So you've got the distribution person coming on. What other team members can you bring on that would actually help you grow the raising the money side of the business?
It's a distribution person. They're gold. The good ones, absolute gold, because that's their job, right? And the beauty of getting someone who's coming from a good established fund is they've got a Rolodex of people who trust them and a fund that's performed well. So, if you were selling product X and then you move to Rixon and you turn up in front of the advisor, they go, Saurabh's the guy who put me onto fund XYZ and we've shot the lights out. What have you got for me next? So that person is a very crucial hire.
Yeah. How do you make sure you get that hire right? Because let me put a negative hat on. The only distribution person that is going to want to leave means either their fund is not performing, or they're not raising enough money to pay themselves.
Yes, that's fair.
They're probably the ones that cycle through jobs every 2 years because it just takes 2 years to get found out. You go jump into another ship.
Yeah.
But if you're a really good distribution person, it probably means your fund's performing, so you're able to get more follow-on capital.
Yes.
And it probably means that you're doing quite well because you're raising lots of money. And then why would I leave to go to Rixon? Like, what's Rixon going to offer me?
Yes.
Or how are they going to attract me when I'm kind of doing okay now?
Very fair question. And that's a huge consideration. We never want to take someone out of a job there and then boot them after 2 to 3 months. And likewise, I don't want to pay someone who's not going to deliver. So the beauty of this space is it's a small industry. So the handful of names we're speaking to are known entities. We've heard about them, or we know someone has heard about them. We can see how the funds have performed. And some of the funds have wobbled, some of the funds have controversy. So that's a fair reason to leave, because they go, look, someone said something about them, the AFR. I don't feel comfortable pitching this anymore.
Yeah.
We're also a high growth opportunity. So you get people who are mid to late 30s, particularly. If you're working for a big fund, until the guy above you dies or
you're
retires,
small cog, and
you're just a small cog in the wheel and you never move. Whereas if you join us, we're talking about second, third, fourth fund. So you've got to create a directory. And for the right person, there's equity. So we're very, very...
Which they'll never get in a...
Never get.
They'll get a bonus, right? That's what they'll get in another place. So Why are you using Recruiter then if all these people are known entities that you can reach out to directly and or could have a conversation with?
So the people, well, time, because I spend so much time raising money, it's inefficient to be chasing people for roles. And second, there might be people we don't know. So we know the organization, not the person. Once you pull the name out, we can make a few phone calls and people go, yeah.
And the recruiter can run around and do that admin and set up the interviews and
Absolutely.
so when you interview a distribution person, I'm going to tell you, I know everybody. Everybody likes me. I've got this great Rolodex. I'm going to raise you all this money on day one. The analogy I'll give is like a salesperson. When you recruit them, you're like, oh my God, I have all these connections. Everybody says they have connections,
Yes.
but they often come out to be very hollow in my experience. How do you make sure that doesn't happen to you as part of this process?
Fair question. Some key tests are, again, you look at the fund, because the fund is legitimate, it has some scale. Even as a worst case, that person is tagged along to all the meetings rather than having a relationship. That's good enough because that gets us in the door. That's base case. Second, I make it very clear to people when we speak, say, look, I know it's a long game, but we're looking for someone who on day one can walk in and go, look, here, 10 relationships I've got. I'll bring you $1 million a month from day one. Then everything else is the big checks. So people know when they turn up, there is an expectation. You're bringing small checks with you. If you're not bringing those small checks, you're not going to make probation very quickly.
How, when a fund gives you, so when someone gives a fund money, one of these wealth managers, how tethered are they to the individual or how tethered are they to the fund?
Depends on it depends. So we've spoken to people where wealth managers where it's relationship based. So very much tethered to the person.
Okay, so they know that person. So, I mean, the analogy I'll give like a real estate agent, right?
Yeah.
I care nothing about the brand of the
Yes.
agency. It's that person that I met. If they go to another place, I'd go with them. Is it like that?
There is an element of that because the wealth managers have their expertise, and their expertise is building portfolios, engaging with the client. They're not equity market experts or private credit experts. So that person they speak to, that front, that distribution person, that's the person educating them. This is what my fund does. This is why it's good. And there's a wobble in the market. They're on the phone explaining that wobble and giving you confidence. So you go, you know what? You might not be the portfolio manager, but far out, you give me confidence and you haven't done the wrong thing by me.
Okay. And how long would it take for this kind of person to succeed? Would it literally be day one, within a week or two, they're bringing $1 million a month worth of additional funds? Like how long would you give somebody?
Well, we give someone at least 2 months for a check of some, $1 million. So if you can't bring in a check within 8 weeks, that means you haven't got those relationships. You're going to use us to start marketing again. That's not going to work.
Yeah. And is that reasonable enough for someone to bring in a bit of money after an 8-week cycle?
Oh, absolutely. Because firstly, you've got a transition period when you leave your job. So you're telling all your network, I'm leaving Fund X and I'm going to turn up somewhere else. I'll be in touch. And people should be, if you're good, people should be calling you going, where you go? You must be going somewhere good. Tell me more about this place.
Yeah.
So by the time you turn up, you've got 3 to 4 months of...
You've done some homework, had some more relationships, had some more coffees, more lunches.
That's right.
Yeah. If it's such an important role, actually, let me ask another question. What's the probability of success of this distribution person? Like, what's the chance they're going to make it through probation? Is it 90%? Is it 10%?
If you get the right person, it's very high. If you get the person the right... So, the 2 candidates we're looking at, which we like, I'd be amazed if they didn't get past probation. Because we've had the conversations. They happen to be people that we know. I'd be very surprised they wouldn't get past. And a big part of that is also our philosophy, which is you don't want to take someone out of a job and say, oh, you're not right for us. Goodbye. You're now unemployed. So we want to make sure we're doing the right thing by you when we take you on board. So you know what our expectations are.
Yeah. Because my experience in hiring has been a bit different. Like no matter how much I've tried, I've recruited thousands of people, thousands of interviews.
Yes.
I still only get it right half the time. So I figure, and that's when I started, it was like 0% success. Now it's my 50%. So I've gotten very good at firing people. So a simple example, I've got some EAs in the Philippines.
Yep.
We wanted to get a new one. So I recruited 4 people.
Yeah.
And within a month, I sacked 3 of them. And I just kept the one that was succeeding really, really well.
Yeah.
In your world where distribution is so important and the cost of that salary compared to the upside is nothing.
Yeah.
Why wouldn't you just recruit 2? And if 2 work, that's amazing.
Mhm.
Why recruit one?
Good question. There's a risk there's an overlap. So if you hire people, they're competing against each. There's some lines of work where you want people competing with each other. This is not that type. This is not that line of work because you don't want to call someone and go, Saurabh called me last week. Saurabh is taking me out for lunch. Why are you calling me? So
But you just divide up the territory, right? You have these are the ones that you know, these are the relationships that you know, and this is I don't know, A to Z, L to K, however you divide it up, right?
yeah,
You could actually divide up a sales territory across two people quite effectively, right? So they don't overlap.
no, not for this line because,
No.
for instance, you'll say I've got an existing relationship with the Bell Pot. I'll say so do I. I know the guys in Brisbane. You know the guys in Melbourne. So it does become challenging. And then when the money starts flowing, I'll go, look, I spoke to John in Victoria who
Can you
called the guy
allocate it? Yeah.
allocated to, and then you start butting heads. So you definitely want a very good structure with rules like that. There's a guy in charge, and then the junior people where you go, look, you manage that relationship. You're not paid as well, but I'm giving you that relationship and telling you, make sure you keep them happy and make sure the flows come.
Yeah. Well, it probably depends if you're very certain they're going to succeed, one recruit makes sense. But I've never recruited someone where I've been that certain.
Yes.
Like even for CEOs, so I place a lot of CEOs in companies being on boards. Even CEOs, you'd think I'd be above 50%. I'm not.
Yeah.
I'm still not above 50%. And the crap thing with CEOs, you get stuck with them for 3 years.
Yeah.
Especially the public companies that I'm on.
Yep.
You just get stuck with them for 3 years.
Yeah.
So I'm very surprised you're that confident. Is that confidence founded?
I think it is. It's because, I mean, you can tell me if I'm wrong, but if you're looking at leadership of a company, a CEO of a listed company, it's reasonably subjective. John C interviews very well. He's actually not a nice guy. Or he pitches, some people markets, they sit down and they can just talk. Whereas the work we do is very, very objective. To use the example of the guys in our credit team, very defined interview process, right? Here's a balance sheet. Talk me through why it's a good lend or not. What would you structure? What metrics would you use? Why? You pull it up very, very quickly. There you go. Are you competent or are you not competent? And then everything else you can train on the job, the way I want my credit papers written. And here's a template. That's how you write it.
Yeah.
So it is a lot more objective, I'd say.
So I would have agreed with you unless I had some of the experience that I've had. So one of the companies I was on the board of, and I'll just share the public components. It's a company called Space Talk, publicly listed.
Yes.
So they do smartwatches for kids. So we had to exit the founder for a bunch of reasons. I was on the board. I stepped in as the interim CEO for 4 or 5 months. And my job was just stabilize and go find a good CEO. And I thought, that's great. That's my thing. I can go find a great CEO. And this is all public. There's a guy called Simon Crowther. He was the CEO of Nearmap.
Yes.
So one of the only guys in Australia to build a unicorn.
Yeah.
And he took that from amazing story, amazing guy, fantastic, lovely. He took that from I think it's like employee number 3 or 4 from a hardware camera company.
Wow.
And I think he got a bit crook, so he had to leave, but it was $250 million by the time he left.
Yeah.
And 2 years later, they exited for like $1.8 billion in the US. So I convinced that guy to join Space Talk.
Yes.
That was 3 years ago. And the market cap is half what it was 3 years ago.
Yeah.
So despite all the evidence, all the reference checks, we probably had like 6 interviews, all people on the board met him.
Yes.
Objectively, only comparing share price, because that's what investors care about.
Yes.
He actually hasn't succeeded. And the revenue now, so when I finished up as the interim CEO, our revenue was say $24 million a year.
Yep.
The revenue today is about $20 million a year.
Oh, yeah.
So I used to be so confident about this stuff. When I met these amazing people that so impressed me, I was awestruck, right?
Yeah.
I'm talking to this guy who's built a unicorn that for some strange reason is actually happy to join this company.
Yeah. So, out of curiosity though, where do you think it went wrong? The top 2 or 3 reasons.
So I think if I was to summarize what went wrong is I recruited the guy that ran a unicorn. I didn't recruit the guy that was the scrappy startup, employee number 2. During that phase, he changed. And I didn't realize I need that guy right at the start.
Yes.
This guy at the end that's used to, running $1 billion business, he's happy to spend $1 million a year on recruitment fees.
Got it.
He's happy to, fly business class everywhere. He's happy to do all these things.
Yeah.
And there were just things I did not untangle.
Yeah.
And even if I asked him, he would have just told me what I wanted to hear.
Of course, yeah.
Because he wanted the job, we wanted him, we were both in love with each other. So that's where I think that went wrong. I recruited the right person, but just at the wrong time. The wrong time for him.
Okay.
So that's why I love your enthusiasm
Yeah.
for distribution. And I'll ask in about 6 months. I just wonder whether you just
Yeah.
get both.
Yeah.
Because let's just say, I don't know, you get both. It'll cost you $1 million. Let's
Mm.
pick a random number for, office space, time, your time, other
Yeah.
people's time. Assuming that you can somehow stop the channel conflict. So you can somehow divide up those things, or you pay double commission, or you pay half, or whatever it is. Sometimes the upside is worth it.
Okay. That's food for thought. It's actually food for thought.
Because what's the worst that can happen besides your cost base going up a bit?
And even temporarily, they don't perform, right? Because they do perform.
It's amazing. You'll grow even faster. And if they don't perform, we'll get good at firing, and they'll know they're not doing well, right? And if you've got this 2-month cycle, you'll figure out very, very quickly.
Yeah, right. So the beauty of what we do is they'll know. It won't be a surprise.
Yeah.
Yeah.
And then they'll know they're not working. And before you might even get a chance to get rid of them, they might just self-select opt out.
Yeah.
They'll start networking and going to find their other job.
Yeah. Yeah.
So that might be something to consider, because the other flip side is, let's just say you get it right.
Yeah.
Let's just say, oh my God, you get 2 rock stars. You've done better than me.
Yeah.
4 times better, because my success rate is 50%. So if you get 2 that's like 200% success rate.
Yes. Yeah.
Then you'll suddenly grow faster. And they'll pay for themselves like super quick, right?
Absolutely. Well, that's a very good point, mate. Because they will pay if they're succeeding. They'll pay for themselves. Easy.
Because I always see revenue generated.
Oh, thank you.
So I always see revenue generators, which they are in this case, right? Because this is the constraint of growth that you have in your organization. You see revenue generators almost like a magic box. You put $1 in, you get $10 out.
Yes. Yes. Yeah.
And when are you going to stop putting in that dollar coin, right? You never will.
Yeah.
And then you might find that, I know some of them, like, if it was me, I wouldn't stop spending money on the marketing just in case both don't work out.
Yeah.
And there is value to your brand, but you might find over time you can spend less on sales and marketing. Because if sales and marketing gives you 2, right, it gives you more people to give you money, more people to want to borrow money off you. And if you have enough borrowers right now, you can maybe shave 20 or 30% off that. And these guys are going out to get you funds. You might not actually need some of that spend that you're doing today.
Yeah.
So there might be a model where the hit to your cost base is actually not crazy. Or it might be a model where you might decide for a year, look, hey, maybe 11.3 is not doable. We can do 11 or 10.5 because we're going to have to take a dip for a year because we're going to reinvest a bit. Then we'll come out better on the other side. How does that kind of fit with you?
Yeah, look, the long-term view, we're open to small sacrifices. Look, investors want strong returns.
Okay, so you can't screw with that.
Yeah.
Okay.
Look, and to be fair, the target return is 10 to 12. So if we deliver 10, we're doing 11.5. We do 10, no one should technically complain. But we like our outperform.
11 is a better number than 10.
Oh, it's fine, and that's really what we so internally, that's the psychological floor.
Yeah.
11. We just want to stick to that 11.
Yeah. Or you just screw the other 5 employees, including yourself, and just say, you guys are making a sacrifice for 12 months, right?
Yeah.
That we just need to double down and reinvest in this business.
Yeah.
If the cash flow doesn't support it.
Yeah. Look, the cash flow would. I mean,
if they do well, it'll support it.
Yeah,
and
absolutely.
If they're not doing well, you get rid of them. So there is no cost out. There's no cash going out anyway.
Well, but perversely, it solves for itself, right? Because they're bringing money in. You're building your management fee pool, which means the guys who are writing deals are busy and there's plenty of money for everyone to be compensated. So it actually does work.
And any downsides of the strategy besides the channel conflict of having 2 distribution people, not one?
A frugal ethnic, which is why I was thinking of hiring one. You've really given me a lot of food for thought about this business of hiring 2. The only downside, so because the industry is small and because we're niche, right now, it's not some HR person 4 floors down making a decision. It's me. We're less likely to get someone who's contentious because we know, it's a small market. So the real risk I see, other than hiring someone who's going to waste our time for 3 months, is hiring someone who sells the product badly. So burns bridges that we've already got or would have built without them. So gone in, given the wealth manager a story that's dishonest to get the money out the door. And then when we get a phone call one day going, this is what you told me, then we've got a problem.
Let's just say something bad happens, right? You just lose, say, a year's worth of growth. For whatever reason, you can't raise more money, or this person does a horrible job, or tanks reputation. How much will that cost you?
Well, cost for a fund of our size, it could be devastating.
It'd be devastating.
Could be devastating, yeah.
Yeah. So there's super high risk of getting this wrong. But then you've got two people that you know that you had some interaction with in the past.
Absolutely.
So you've kind of de-risked that.
Yeah, they wouldn't be cowboys because, you get people out there who are aggressive. We would never hire people like that. We know these guys and I've spent time with them. Very stable.
What would be the cost if they didn't perform for, let's just say, a quarter, right? For 3 months, because most people can fake their way through a quarter.
Yeah.
You might be really clever and catch them in 2 months, but most people can get to a quarter. They can fake themselves.
Yeah.
And there's this deal just about to come. We're about to do it. And, oh, look, they're just about to raise some more money. And, in April, no, it's May now. Oh, mate, 1st September. It's totally locked in. What would be the cost of that if they drag this out?
Well,
is there a lot besides their salaries?
It's not the salary. It's really just the salaries.
Because you're kind of raising money, doing the organic way in your own kind of tasks anyway.
And the risk of that is also low because of our size, what I would ask them to do, and it's not a matter of not trusting, CC me in every email.
Yeah. You go along to meetings, you help them, make sure they're legitimate, make sure they actually know that person has some value in there.
Yeah.
In them.
Yeah, you're not going to Mossman sitting having coffee by yourself, buying two coffees in Mossman now.
Yeah.
I'll be there with you. And again, with the good guys know what they're doing.
Yeah.
Yeah.
So going back to your point, which I can relate with, is an ethnic frugal. I love it. Is this the right place to save money?
That is a very good question. So my shareholders, my small cornerstone investors aren't ethnic. And we get along very well. And this is where they do test me. Why don't we spend this? And they go, look, think about it from an ROI perspective. You spend this and you get that. Does that make sense? And I go, actually, it does. So we challenge ourselves there. So my default position is still don't spend. But if someone can put a case to me and explain why this actually makes sense, very open to do it.
But I guess the difference here is, how come you didn't put this case to yourself? Because you're the CEO, you're making this choice, right?
Yes.
And there's actually no one to put this case to you except you for yourself?
Yes. One key reason as well is, again, if you look at the fund today, two fund is all optics, right? Two funds, $170+ million, or very, very nice. But the fund's done this. So 12 months ago, it was not a happy Christmas. Fund was much smaller. I've only come back to a market salary. This month. This month, I've been on like a graduate salary for about 2.5 years. So the challenge with being tight is you see the world from a capital constraint standpoint. So we finally hit a point where we can afford a distribution person, let alone two.
But now today, could you afford to if you had to?
We could afford to.
So now today you can afford to. So the reality is a bit different to what it was, like 6 months ago.
Absolutely.
So how come you didn't figure this out? That maybe I should get two instead of just getting one. What stopped you from thinking about spending that extra money?
I mean, the trauma of trying to get the business in the black while being able to support yourself.
Yeah.
Very frank, that's really what it is, right? Because
explain that more.
So the biggest change in the business for me is even 12 months ago. Is this business going to survive? Yeah. And how on earth am I going to look after my family? Fast forward to in the last 3 months, because the business is in the black and it's done this, you're not thinking about survival, you're thinking strategically, which is why we're thinking about the distribution person. We set up the second fund, and because I'm on a proper wage, I'm not worried about the wife and kids anymore. So that mindset is a huge change.
How long were you in the red for?
The business was in the, look, it's very easy for the business to be in black when I'm not being paid. So look, we weren't in the red for long.
But if you were being paid, if you did get a market salary, how long would it have been in?
Probably until, so it's 3 years in, so 24 months, 2 years.
And that's completely normal. That is completely. That does not sound like enough trauma to warrant this behavior.
Yeah.
So I wonder whether there was something before. Like, where did you learn the ethnic frugality from?
I think being an ethnic immigrant, really. That's, I mean, this is more personal, but I've lived a very blessed life, So I'm from Malaysia, I went to university in Brisbane, straight into investment banking in Singapore. Life's been good, but I'm actually from a bang normal middle-class family in Malaysia. The only reason, my change of life was university in Australia.
Yeah.
And the only reason that happened was fees were much lower back then. I had family in Brisbane, so I had no living costs, and I won a partial scholarship. So as I said, the stars aligned, the gods view, and that was my stepping stone into something that put me on a complete different life path. So I think it's that step change that you always remember. And you go, I never want to go back to where the pre-Australia days.
Yeah. I mean, it's the, you spoke a little while ago about funds managers, like sometimes the upside is not worth the downside.
Mm.
And there's nothing worse than being poor again. There is
Yes.
nothing worse. When you make money,
Yeah.
number one rule is just don't fucking lose it.
Yes.
Just don't lose your money. Which serves up to a point, right? And serves really, really well, and it's super protective. But sometimes it doesn't serve you really well.
No. But it's easy. Well, like it's very logical now when I speak to you about it. But at the time, so you imagine, like, you come from that background, then you get into investment banking, and I've did banking for 15 years. And overnight, when we set up Rixon, no more Uber Eats, no more fancy restaurants, no more overseas holidays, no more shopping trips for 2 years. Now, it doesn't sound like much, but that's a huge. As arrogant as it sounds, I've never lived like middle class. I'm cheap, but I've never lived. I tasted what middle class life is in Australia. That's with the mortgage and a child in private school, and I went, oh God, I need to get out of this and back into a proper wage and
Yeah. And look, I wouldn't underbake the trauma, because it's not just what's in your head. So it's 2 daughters, wasn't it?
Yeah.
Yeah, your 2 daughters would have noticed.
Yeah.
We're not going overseas. We're not going on the ski trip. Your wife would have noticed.
Oh yes.
And I'm sure your wife is lovely and supporting. But after 3 months, 6 months, the father-in-law's probably calling, saying, what's going on? It's like when I decided to, originally my plan was to retire about 4 years ago when I exited that business.
Yep.
And I told my mum, here's a plan, kind of have enough. The first thing she said is, what would your father-in-law say?
Yeah.
Useless son-in-law.
Yeah.
Well, my wife wasn't making that much money back then. She does all right.
Yeah.
Useless son-in-law, he does nothing.
Yeah.
I'm like, Mum, I've made actually all this money in the past.
Yeah.
The social pressure from the family is intense.
Yes.
And what I've learned from so I'm a meditator, like that's what I do.
Yeah.
So I'll do my 2,000 hours a year of meditation.
Okay.
Probably more than I do working these days.
Yeah.
But one thing that I've experienced is what happens with the trauma, and why when we logically talk about it, it makes sense. You get stuck in a very deep part of the mind.
Yes.
Where you literally physically feel something. You feel that anxiety, the pit in your stomach, or you feel something somewhere in your body.
Yeah.
And it gets stuck in a part of the mind that doesn't understand language.
Mm-hmm.
And that's where it sits and resides for your entire life.
Okay.
Unless you go meditate and figure out a way out to pull it out. So as much as this logically makes sense, might not be the right place to save money.
Yeah.
It completely makes sense that you're still basing your decisions on an emotion that you experienced a couple of years ago, because that stuff gets buried deep in your mind. And that's why, people, if you ever had grandparents who went through the Great Depression, 60 years later, they've got money, but they still think they're poor. Because that trauma just got buried deep in their mind, and they just don't know where to pull it out.
Yeah.
Does that resonate with you at all?
Absolutely.
Which part?
The part about the trauma 60 years later, because I think I've changed as a person after the last 2 years.
Explain that.
I was small, so I was always frugal, but I've never been more careful. And
now you're next level frugal.
Next level careful. Just literally tell the kid, we'll go to the restaurant. And, they'll get the girls.
No entrees.
We'll do that. But yeah, the girls will get a salad, a dessert, and not finish it. And they'll be like, oh, it's a little left over. And I will go, that was $12 dessert. And you've eaten half. And I will sit there and eat it, which is insane for $6 and a leftover, which I wouldn't have done 2-3 years ago, because that the value of that dollar has just been driven. I was always frugal, but the value of that dollar, because when you look and go, oh my God, this is what can happen when you run out of money.
Yeah. It's kind of funny. People without a lot of money, and people with a lot of money always think about money.
But people without and with a lot.
Without, so if you're like sub $500,000 and you're more than $100 million,
yes,
you always think about money. Because when you're poor, every expense, you just got to think about.
Yes.
You quickly tally the cost of this meal in your mind.
Yeah.
Should I do it? Should I not do it? Should I buy that drink? It's just like university days, right?
Yeah.
We don't have a lot of money.
Yeah. And
you're like, oh, I won't buy a soft drink because it adds an extra $1.50 to the meal. I'll just buy that. Or I'll just have leftovers from the day before.
Yeah.
And ironically, people with lots of money, they just completely obsess. At least in my experience, they obsess about money.
Okay.
Because that is their defining characteristic.
Yeah.
Everyone's trying to screw them out of their money.
Yes.
They got all these leeches hanging onto them.
Yep.
And they completely protect themselves.
Yes.
And that's their measure of success. And you're probably lucky you were somewhere in the middle before where you didn't have to obsess about money.
Yep.
As much as you probably did during the harder times.
Yeah.
Because during the harder times, as you chew into your savings and you see the cash balance go down every month, that sucks.
Yes. And you're a good banker, right? You run that extrapolation in your head. There's 12 X many more months.
You had a spreadsheet, I'm sure. And you're like, oh, great, I've got 12 more months of food left.
That's right. Before you've got to make a decision. And the big decision we made when I did the business, and this is also a big leap, was if you're a engineer with Lend-Lease and you go, look, I'm going to try something in Dubai, Lend-Lease will take you back in a heartbeat when you come back to Sydney. Where this line of work is very competitive and there's a real human element to it. So when I left the M&A/private credit house, the next one, it was under very bad circumstances because they were furious I was moving to a competitor. When I left that shop to set up my own shop, they tried to sue us because they went, you're building a product that we dreamed of building ourselves. So there's no plan B.
Yeah.
When you set up, it's not like someone's gone, you call me, if it doesn't work out, we'd love to have you back. It's cross the road if you see me because I don't want to be near you.
And it's probably even worse than that because if you become an entrepreneur, and at least in my experience, if I was recruiting a CEO or a CFO, so if I was recruiting a CFO, I would not recruit an ex-CEO.
Okay. Yeah.
Because I'm like, well, you've actually run your own company. Why are you going to want to work for me one level down?
Okay. Yeah.
And your true ambition is to run your own business.
Yeah.
You might settle here for 2-3 years and then you'll go out and do it on your own. And that might be correct. That might not be correct. But that's a general perception that, board members or CEOs have as you kind of bring people in. Yeah. You don't want someone, the incorrect term is overqualified. It's not that you're overqualified. You've just got more experience that's shown you the freedom of the world.
Yes.
That a typical employee doesn't have.
Yeah.
So if you were to pull the ripcord, it might have taken 12 months to recover, right?
Yeah.
To go find another job, make sure you find the right place. You might have to do one, not quite fit, find another one. So there was a long cost to change.
And I don't know if I could be an employee again.
Yeah.
You're a long-term entrepreneur. I'm a corporate man until 3 years ago. And you hear that, I used to hear that from people all the time. So what do you mean? Job's a job. And now I work harder than I ever have, but I miss nothing at schools. I'm always at the school for music and sport. When I'm not raising money, I'm in the office in thongs and shorts. It's pretty, my wife says it's disgraceful, but it's just that power of I do what I need to do to achieve a result as opposed to playing politics or being a cog in a wheel where you're irrelevant.
So I've always worked in corporate.
Oh, you have?
Yeah, I've always worked in corporate. The only entrepreneurial thing was CEO of a public company, but I've always worked in corporate. But I've never go back to not being a CEO. I don't work full time anymore, but not being a board member. Because what you touched on is very nuanced. You have freedom. Like it's something that, Gandhi fought for, right? The freedom to choose what to do with your time.
Yes.
And when you're an employee, you just don't have that. And when you taste that, you're like, I just don't think you can go back.
Yeah.
And if you go back as a sad, emasculated man.
Yeah.
Because, well, you kind of failed in life and now you've had to suck it up and go back to this.
Yeah.
So,
and where we sit, so we're in 3 String Street and I look up and I can see Farrer Place and Grosvenor Place where all the bankers are. And you look out the window and you can see the guys, beautiful navy suits, like looking like $1 million, big salaries, big companies. And I look and I go, these guys, if you want a social catch up, they can meet you for lunch, maybe for a coffee for 15 minutes. They're slaves, right? It might be $500,000 a year, the big bonus as well, but that is their life.
They have no freedom over their time.
No freedom.
Absolutely no control at all.
Yeah. I'm there in thongs and ripped shorts. And I go, you know what? It's not Apollo or KKR. Far out. I'm in charge of my life.
Yeah.
Yeah.
So and I guess the moral of that was that's why it'd be so hard to go back to a normal job after this.
Yeah.
One, for you to accept that, and for another employer to accept that this would actually make sense to come back to here.
And the other part I find very difficult after being an entrepreneur is understanding what you're paid versus the value you create. Right, the guys that KKR, he's on $500,000 a year salary. He's making them multiples of that. And now I see it. Right? We just talked about hiring the distribution person. Right? We'll pay him a big salary, but he's making more than that.
Yeah.
And now I would go, hold on, so you're paying me X, but I'm doing Y at 2X. Why shouldn't I do this myself?
Oh, totally.
Yeah.
I think the only time it makes sense to work for someone else is at the start of your career, when actually what you're getting is training. You're
Yes.
getting skilled up on how to do something. So in that case, you might generate more cash than you cost, but your upside is skills,
Yeah.
competences, experience. But as soon as you're competent, you should totally work for yourself. Otherwise, you just don't get enough of the economic gain.
No, you don't. Yeah. And, you know, and there's things.
And don't tell too many people that, 'cause that would be
No.
horrible. But you just don't get the economic gain for what you generate.
But the other interesting thing I've learned is when you say that, most people, well, there's a reason the entrepreneurs and people who have great corporate careers. You'd be amazed. Well, I'm surprised the number of people who are happy with that regular paycheck. And I understand why, right? I can take time off when I want time off. And when I'm on leave, I'm on leave, you know, whereas that's not the case for an entrepreneur.
I think it's more nuanced. I think that there's two reasons people do that. The most common one, it's fear. I'm actually not that good. I might get found out. I'm an
Yeah.
imposter. What if they sack me? I've got a mortgage to pay. I've got my kids in private school. I can't go for a week without working.
Yeah.
I'm just too afraid to go do this myself.
Yeah.
That's why I did do a startup when I was young. I was like 17 years old. Best thing ever.
Yeah.
I didn't know any better.
Yeah.
Ran it for 4 years, sold it to Telstra. But I was young and naive and didn't know that failure was a thing.
Yeah.
But when you get married and when you get a mortgage,
Yes.
and the bank is going to guarantee you take that mortgage out of your account every month,
Yeah.
like the fear settles in and that insecurity that we're all bred with. Like everybody that I know has imposter syndrome.
Yeah.
I think it's a deeply human evolutionary thing.
Yes. So you never overstretch yourself and put yourself at risk.
Yeah, that's right. Because
Yeah.
that would not work well for a tribe of 200 people, for someone to go and do something by themselves.
Yes.
You'd always kind of norm back to the mean. So that's one of it. I think it's the fear. That's probably the greater one. The other one is there's nothing wrong or right about it, because some people, ambition is not their number one driver.
Yes.
It might be family, and that's amazing. That's fantastic. It might be their church. It might be travel. It might be love. It might be poetry.
Yeah.
But when ambition and work and growth is not your number one driver, you don't spend time there.
No.
You want to take the 4 weeks off. You want to go on holidays. You want to get home at 3:00, or just 5:30, knock off straight away, turn off your phone, and go spend time with your family.
Yeah.
Ironically, I reckon if you front load the work, you'd get more time to do that anyway. But I don't think a lot of people see that.
No.
Also, because of the fear, they actually don't think they're going to succeed.
Yes. Yeah.
Did you have that over those 2 years? The possibility that you weren't going to succeed?
Absolutely. And we had a very rough start. So the story is, like a very sensible person, what I did was I set up a landing page for the fund while I still had a job. So the landing page basically said, look, here's a fund that doesn't exist. This is the idea. This is what we'll do. If you're interested, fill in the form and some guy will call you, which is me. And we raised $10 million of interest on that alone. I went, there's my proof of concept. So we bit the bullet, set up the fund. Then I picked up the phone to all these people, and everyone went, oh, you want the money now, do you? Let me check with my accountant. My wife says no. Oh, I'm buying a property. And that $10 million went to one.
Okay. Evaporated. Yeah.
So you're sitting there going,
Yeah.
I'm sitting in a room. I've got rent to pay. I've got a
You've got a cost base, yeah?
I've cost base. I've got a borrower who wants $3 million in 6 weeks, and I have no money. And that's when I went, oh God, what have I done? So we had a Rolodex of names that people had shared, my cornerstones, and the few people who had supported us said, look, call Saurabh, call John.
Yeah.
And for quite literally for 2 months, up and down the corridor.
You called everybody?
And I'm an introvert, and I never thought I'd do sales because I thought I'll build a good product and the money will come. And I basically had to sit there in the office at 2:00 in the morning going, if I don't learn to do sales, I'm screwed. And best thing that I ever did for a skill, 2 months, just walking up and down the corridor on the phone, selling. And you go from terrified to confident. You get you're ready for questions. Your story becomes very, very clear.
You get great muscle memory.
A great muscle memory. You just articulate what you do and why you're different in fewer and fewer and fewer words, in simpler and simpler and simpler language. I still wouldn't want to go back to that, but that was, when you went, oh my God, what have we done?
And that was you and a co-founder at the time?
Yes.
Was he? Okay.
Yeah.
Was there an option to pull the ripcord and just say, nah, this is too hard?
No option.
You'd already quit. Your previous employee was suing you for going and setting up another fund.
I'm not joking about suing.
Yeah.
Yeah, so we had to get lawyers. Yeah. So they already sued us. We'd gone public that we'd set up a fund. We signed all these documents with an FSL provider, a trustee. So they're all 12-month contracts. So if we pull the plug, I'm on the hook for 12 months anyway, or they're going to pursue me for costs. So I had to write it out.
Was it more that, or was it more the personal, emotional? I don't want to use the word ego because that's the wrong word, but that you've now made this your identity.
It does become your identity, yes.
Because that's your identity. Now you've gone out, you've set up yourself, you've
Yeah.
probably told all your friends and family, this is what I'm doing. It's a great idea. I'm super excited.
Yeah.
Your mum's thinking, oh, great, my son's going to become a billionaire one day.
Well, he's a managing director of his own business.
Yes, you're right.
He's
a CEO.
of himself. There's that. But I will say one thing that kept me going, I knew it was an amazing product. And that's what I tell people now. It's an amazing product. I'm not trying to sell you something that it's not 10 guys are selling it, but back me because you like me. I'm genuinely different. So I had the confidence that it was different and it was exceptional. And I did have I knew that there's nowhere else I could have gone, but I knew that if I stuck with it, it would work. And I had that confidence.
Yeah. Okay. Makes sense. Let me just give you one other analogy. So I released a podcast today, interview a little while ago. Today is the 8th of January with a guy who's setting up an ex-AWS product manager. He's setting up a mortgage lending business, home loans.
Okay.
Which is going to become a mortgage broker.
Yes.
And traditionally, a mortgage broker gets paid about $500,000 a year. It's a proper sales role.
Yeah.
You have to go out, find people, find which bank will lend the money.
Yeah.
I guess the resi version of what you do, kind of-ish, but a bit simpler because they're not managing a fund.
Yes.
Traditionally, they get paid about $500,000. So his theory was, what if I made a better product? What if I paid my mortgage broker $100,000 or $150,000, but the interest rate was 0.15 or 0.2% cheaper?
Okay.
So it's a better product. What if I could actually have a lower cost of sales? Would I attract more people?
Yes.
Or maybe I'll give them back $10,000 when they sign up and $10,000 a year for every year that they keep the loan.
Okay.
So his real theory was, what if I had a better quality product? Would it sell itself with a lower cost of sales? And my experience has been that almost never works in the short term. Almost everything you buy actually has an insanely high cost of sales.
Yeah.
And it takes a while to figure out if the product is good or not. That's your 5-year track record.
And, you've got to survive 5 years to have a 5-year track record.
Yeah.
Exactly.
Yeah. So I hear that a good product is important. Yeah. And I think that's foundational. Yeah. Like if you have a crap product, you'll have insane churn and people put money in and in a year's time, they'll take all the money out. But I think it's okay to have a high cost of sales.
Yes. As long as there's an ROI on that cost of sales.
That's a given. That's a given. In his world, this mortgage broker, his business, he's thinking, well, okay, I'll save $250,000 a year per broker and I'll just channel that money back to a lower mortgage rate.
That's very interesting as an idea. That's very interesting as like just thinking, that's not my business, but that's the sort of thing you get free advertising. Like the morning show or the Today Show, they'll bring you on and for free because
I'll totally tell him. Yeah, well, he's launched out some Monetas, so he's just launched this week.
Yeah.
And he'll give people better rates. But I just wonder whether that model will succeed or not. I'm 50-50 personally, because my take on that was, if there's 100 people that are going to sign up to a mortgage, I don't know, 50% will do the work with him. Yeah. 50% will probably just never return the phone call. Yeah. And of the 50% that are working with him, 48 out of 50 will need a really good salesperson to hold their hand and take them through the entire process. Yeah. Because they'll get busy, they'll forget, they won't send the right pay slip, they'll do something wrong. And if you have a below par salesperson taken through that process, they just won't convert. Yes. And that's why I think a lot of the organizations that do well have a really, really high cost of sales. Like Apple has an insanely high cost of sales. When you go to they've got amazing stores, they don't think they pay their geniuses that much, but there's a lot of them. Yes. Like they are flooding every floor of their store. So to bring that analogy, so just to finish it off, so my experience has been, it's okay to have a high cost of acquisition. Yeah. Because if it works really, really well. Yes. And if it doesn't, and if you have a low cost of acquisition and you
Mm.
don't succeed, you actually don't know why. Was the product
Yes.
not differentiating enough for me to succeed, or did I just have a crappy salesperson?
Yeah.
So bringing that back to you with 2 distribution people, maybe it's what it will allow you to do is run a clean experiment.
Yeah.
Like you'll actually know at the end of it, is getting a good distribution person right?
Mhm.
So the analogy I'll give also, the James Webb Telescope? It's a new telescope. NASA cost tens of billions of dollars.
Okay.
So the problem with Hubble, the prior telescope,
Yeah.
it could only go back about 13 billion years,
Okay.
which is huge, right?
Yeah.
But it could only go back 13 billion years. And I think the universe is like 13.2, 13.4 billion
Okay.
years. So they built a telescope that could go back 15 billion years.
Yes.
Because they're like, we want a clean experiment.
Yeah.
We want to be able to see to the end of time in case there's something beyond that.
Okay.
And they just spent an insane amount of money to actually run that
Yes.
experiment. And I don't think it's got any results yet, but
Yeah.
at some point it'll tell us
Yeah.
how old the universe is.
Yeah.
But they just overspent
Yes.
thinking that we actually, there's insane value in figuring out this experiment.
Yeah.
And that might be in your case. There might be insane value in figuring out, is a distribution person actually going to work? And if you get one person they don't work, you actually don't know.
Yes.
If you get 2, you've got a pretty good idea.
Yeah. What works and what doesn't, and who's doing the right thing. That's very, very interesting food for thought.
Yeah.
Because you're right. And the advantage we have versus your friend, I still think we have a lot of free advertising.
Yeah.
Is
I'll totally tell. Let me tell them.
yeah. Is cost of execute is also complexity of execution. So with our guys, it is a script, and they're smart guys. These distribution guys are very smart, and our product is simple. So you tell someone what to do. All they have to do really is find people to put the pitch to. Whereas with your friend's thing, you're right. Well, the product technically sells itself. The execution's complex because I don't have my payslips. I keep giving you the wrong tax file number. I know, whatever it is. So you need people who are able to churn through all those steps. My guys don't have to do that. They just need to be
People
motivated.
on the borrowing side do that in your world, right?
They're
the guys that have to chase people for the
That's right.
data room or the financials or the audit report, all that
Yes.
stuff. Yeah.
So the execution's not hard. It's just hustle and network.
Yeah.
Yeah.
And hustle and network is hustle you can kind of interview for, you can get a vibe for. Network, it's so hard. It is just so hard.
Yeah. Yeah. No, I hear you.
Yeah. I mean, everyone says they've got a great network
Yeah.
and they'll list off 30 names and you'll check a couple and they'll work. But
Yeah.
it's hard to find people with good networks that will actually pull. I mean, the only person I've actually found, the guy, Mike Rad, ex-premier of South Australia.
Yeah.
So he was on one of the boards I was on.
Yeah.
Fantastic guy, super lovely guy. He had a legitimate network. So when we wanted to go meet a WA education person, he would go call the right person and set it up. So people at that level totally have, but 3 levels down, often they don't, or often they're shallow, or often the half-life is very short.
That's a good point. Yeah. 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 I know a grad somewhere who's rotating through teams, so he's not there anymore.
Yeah.
Yeah.
Yeah. Perfect. Anything else you wanted to cover? Or, I mean, what's your big takeaway from this?
Look, I enjoyed the dissection. I mean, this is really the value of these things, right? Because you're caught in your silo and I know my little world. Well, I'm caught in my silo in my world. It is very valuable to speak to someone who has run a business, particularly looking at it from the outside, ask challenging questions. With that financial return on investment mindset, I mean, that point about hiring 2 distribution people actually makes a lot of sense. Really makes a lot of sense because most importantly, there is a probation period. You're not delivering, you're out. It doesn't cost you anything. So and that person knows that they're not down. They know that as well. So someone comes on board assuming that odds are you've got the right person.
Yeah. And if they both work, oh my God, the upside's amazing.
And the upside is incredible. As I said, they pay for themselves. Yeah.
Right. Anything else you want to cover or wanted to ask or any major takeaways?
No, that was fantastic. Yeah, thank you.
Well, last question I always ask people as they finish up.
Yeah.
Well, what's something that you've always known to be true that later on you found that actually wasn't?
So far out. Always thought to be true. Well, and I'll tell you this one. A few of the dads have had a chat about this. Obsession with grades. It was more for young people or parents. When I grew up and a lot of the ethnic families, there's this obsession with the top student. You've got to be the top student, the chess player, this, that. That's your path to success. And I'll tell you one thing I've learned, that is not the path to success. You need a baseline of skills so you can learn, articulate your understanding, but it's those people skills that build your career.
Yeah.
And I find a lot of immigrants, they might be controversial, but you hear people say, I didn't get promoted. It's racism. It's not racism. You're technically very competent, but that's the analyst. I can't make you the head of the team because you need to be able to speak to the board, not just speak to the board, manage the board, right? Saurabh's an easygoing guy who takes feedback. John is a hard-nosed guy who needs to be managed. You need someone who is able to do that and recognize that.
I totally agree with that. I mean, the lens I'd add though, young kids, I'm obsessed with grades. Because if you can get both, if you can get grades with the ability to work super hard and you learn to work super hard, I don't totally quite know how to teach people skills yet. I think that's just time, experience, interacting with more people.
Yeah.
But there is insane value in people skills.
Yeah.
And a lot of the people that do well in life somehow get both. Like they're smart, they work really hard, and they're good with people.
Yeah, that's a magic recipe, right? And I do find a lot of people in the startup world and finance who do well tick both those boxes, right? Academically, you shut the lights out, but you can go from the restaurant to the pub to the conference, the office, and just blend in. And that is a recipe for success.
Awesome. Great. Thanks very much. Thanks for coming out.
Yeah, real pleasure.
Very nice to meet you. Thanks for listening. I hope you enjoyed it. If you do want to be a guest, make sure you hit me up and do follow me on socials and make sure you check out future episodes. Thanks, guys.